Good day, everyone, and welcome to our webinar for January 2022. I hope you had a good festive season, and here's wishing you all the best for this year. Of course, the big story over the festive season as far as stock markets were concerned was the shift from dovish to hawkish sentiment in the US, and particularly in America, but also here in South Africa. The new governor of the Federal Reserve Bank in America, Jerome Powell, is said to be considerably more hawkish than his predecessor, and he's talking about increase in interest rates. In fact, the minutes of the Monetary Policy Committee meeting in November talked about 4 interest rate hikes this year following the end of quantitative easing. So that's quite substantial. That will take interest rates in America up to around 1%. Of course, South Africa has already done 2 interest rate hikes, and we are expecting another 3 this year. So we're trying to stay ahead of the trend so that our bonds, of course, remain attractive to overseas investors. The motivation for all of this is that US inflation reached 7% in December, which is a 32-year high, and really quite extraordinary. As I said, the new governor is concerned about inflation, and it's been obvious for some time that quantitative easing would result in inflation eventually, and it appears to be doing exactly that. It's interesting to note that in the 22 months since COVID-19 began, about $11 trillion has been printed by the American government and injected into their economy through quantitative easing. That has pushed the American economy back into a boom. Unemployment has fallen back below 4%, and that's roughly where full employment is thought to exist. So, of course, as soon as you reach full employment in an economy, wages tend to go up because employers are bargaining for scarce labor, and they will push wages up. In our confidential report on the 3rd of November last year, we said, we have for some time been drawing attention to 10 mini corrections of less than 10% in the S&P 500, which have occurred over the 20 months since COVID-19's V-bottom in March 2020. We have suggested that these would surely be followed by a major correction of between 10 and 20%. And then in our confidential report on the 1st of December last year, we said, we have warned on various occasions that a major correction of between 10 and 20% is overdue on the S&P 500. It's just that we think it is more likely to come next year rather than before Christmas. And then finally, in our article on the 24th of January 2022 this year, we said we have consistently warned of a major correction of between 10 and 20% for the past few months, and to us, this looks like it may well be it. If we are right, we can expect the S&P 500 to fall to somewhere between 4,300 and 3,800, with a similar impact on the JSE. So what we are saying is that a major correction is now in progress. If you look at the chart on your screen, you will see how the S&P 500, which was tracking this trend, the underlying upward trend with lots of these mini corrections in it, has now broken down through that trend line and came down very substantially to reach and find support at the previous cycle low. So here you've got what we consider to be a major correction, as distinguished from the mini corrections of sort of 4, 5, 6% that we've seen in the past. Of course, the last 3 days, including last night, the S&P rallied quite strongly off this support level here at 4,300. But that may well be what we call a dead cat bounce. And this is something that you should bear in mind. In our article on the 24th of January, we said that this correction could take us as low as 3,800. And our that old saying, that if you drop a dead cat from high enough, it will bounce, but it's still dead. We say again, this is not the start of a bear trend. It is a correction, but it may go down further towards somewhere around 4,000, we think. So this could just be a dead cat bounce that you're looking at here, and you need to be careful of that. Of course, there is fear that there's a bear trend coming. Rising interest rates was always going to cause that fear, and fear of rising interest rates was always going to lead to a correction, especially in a bull trend which has been going on now for a record 13 years. It's also true that eventually rising interest rates will cause a bear trend, but not until rates are around 3 to 4% in America, we think. Because at that point they begin to impact on corporate profits and the profits of the S&P 500 companies. After the 4 rate hikes that are expected this year, interest rates in America will only be at about 1%. So we see the bull trend continuing this year at least, and certainly next year, and possibly longer than that. If we are right, then this correction, once it is completed, will be a buying opportunity. But as we said, the correction may well not be over yet. So just be very careful. It hasn't, in our opinion, fallen far enough. It's only fallen about 10% on an intraday basis, and that's not enough. It's got to fall somewhere between 10 and 20%, we think. So we're expecting another downward move towards 4,000. The JSE overall index only fell by 5.3% so far at its maximum, and has since recovered to be about 2.5% down. We think there may be more downside on the JSE particularly. Our 2 favorite shares on the JSE are Lewis and Avenge, which we'll talk about later, and they're both looking very cheap. Both have come off, but not very much. It's also true that other favorites like Capitec, Clicks, and Process and Transaction Capital have also come off a little. In the meantime, the US economy had a 1.7% growth in the fourth quarter last year. So GDP went up by 1.7% in the fourth quarter. And the growth for the whole year was an amazing 5.7%. This is enormous considering how big the American economy is. And it's the strongest growth of any year since 1984. And of course that is caused by ultra-low interest rates and the massive quantitative easing that we've seen. All this money that the American government has been printing and injecting into the American economy. Also, another factor that's helped quite considerably is that the COVID pandemic seems to be under control. Vaccinations under the Biden administration have increased substantially, and there's been a sharp rollout there, so that has helped quite a lot. Profits from the S&P 500 companies are expected to grow about 9% in 2022. This is very strong, but it's far less than 2021's 45% growth in profits. And GDP in 2022 is expected to be about 4.3% up on the year. So that's less than 2021, but still very strong growth. It's interesting to note that about a quarter of the Standard & Poor's or the S&P 500's market cap, it consists of 6 technology shares: Apple, Microsoft, Alphabet, Tesla, Amazon, and Meta Platforms. All of these are growing on the back of disruptive technologies. All are bringing substantial new productivity to the world economy. In 2022, they will probably not dominate to the same extent, but they will probably continue to grow. The growth in the American economy should broaden to involve other less exciting sectors. Profits will continue to grow even as the Fed tightens interest rates, until a certain critical point is reached, when the rate begins to impact on the profits of listed companies. And we don't think that will happen until at least 2024. So what we are saying is that the bull trend will continue, that what we are looking at is a correction, but that sometime after the start of 2024, you should again reassess the situation as far as interest rates in America are concerned. All right, let us turn our attention now to what's going on here in South Africa. On the political front to begin with, of course, we had Zondo's first report on state capture, which damaged the ANC's image substantially. It identified a number of senior leaders, particularly in the ANC, and recommended investigations by the National Prosecuting Authority. Of course, he's just launched his second leg of the report, and that has revealed even more problems, particularly with ANC ministers and so forth, like Gigaba and what happened at Transnet. Of course, in the middle of this period, we also had Lindiwe Sisulu's attack on the judiciary, and that has become another problem for Ramaphosa. She apparently will be a candidate for president of the ANC's at the ANC's elective conference in December. She is siding with the corrupt populists like Magashule and Zuma. She met with the Gupta associates in December, apparently, in Dubai, and may have been briefed there. Ramaphosa's response has been weak and ineffective, in our opinion. At the NEC meeting last weekend, Cosatu said that the ANC is dying. I don't know whether that's true or not, but Cosatu is clearly against Sisulu and her attack on the judiciary. All of this, however, increases uncertainty in South Africa and damages our image with overseas investors. Almost 3 years have gone by since Batohi was appointed as head of the National Prosecuting Authority. No convictions have been achieved for state capture so far. The recent election results show the country's disappointment at this. It is unlikely, in our opinion, that Ramaphosa will be displaced at the ANC's conference, but if he is, it will be very bad for the country and the JSE. But of course, Ramaphosa has faced and beaten other attempts to remove him from his position. There's no reason to believe that the elective conference in December will be any different. It does, however, seem likely that the ANC will get less than the 50% of the votes in 2024. Suddenly that will make Parliament very important. Up until now, Parliament has just been used to rubber stamp ANC decisions. But after that, the debate in Parliament will be critical, and the ANC will have to garner support from other people, from other parties. The failure of the ANC to get their land reform changes through in the Constitution is a move away from populism. But I think it may undermine their position in the elections in 2024. Of course, interfering with property rights goes to the heart of the economy, and obviously this idea has scared some overseas investors. Right, let's look at the economy. The Consumer Price Index rose to 5.9% in December 2021, mostly because of rises in the fuel price and some food price increases. This is just within the upper limit of the Reserve Bank's target range of between 3 and 6%. It fully justifies the Monetary Policy Committee's decisions to raise rates in November and now again in January. We expect 3 more rate hikes this year here in South Africa to enable South Africa to stay ahead of the US. Our inflation rate is still better than the US's 7%, and certainly far better than other emerging markets like Turkey's 36%. Rising inflation, of course, means rising interest rates, which eventually means falling stock markets. The Monetary Policy Committee must keep the real interest rates ahead of the first world. The yield on 10-year bonds in South Africa is about 10%, against an inflation rate of, let us say, 6%, which gives us a 4% real return on our bonds. If you look at the American situation, the yield on the Treasury bill, the 10-year Treasury bill, is about 1.78% against an inflation rate of 7%, which means the real return is minus 5.22%, considerably worse than what you would get here in South Africa. Positives for the South African economy include low inflation, the recent upgrade by Fitch Ratings, and of course our deficit, which is now likely to come in under 6% in February, when the budget is handed down by Godongwana. Much of that, of course, is due to the ongoing boom in commodity prices. Other aspects of the economy have also improved a little bit. Retail sales is very important. Consumer spending generally makes up about 65% of GDP. So, of course, the economy looks good when consumers are spending. Consumer spending has been hammered by the impact of lockdowns in the pandemic, the July civil unrest, and, of course, more recently, load shedding, which has resumed. However, consumers are benefiting from lower interest rates, a benefit which is rapidly disappearing now. In the year to October 2021, retail sales increased by 1.8%, down from September's 2.1%. Of course, we have record unemployment of 34.9%, which is a problem, and that has been to some extent offset by the commodity boom. And none of this has been helped by the 8-day strike in the metals and allied sector. Manufacturing production fell 8.9% in the year to October, mainly because of the civil unrest. The true cost of that unrest may be as high as 50 billion rand, directly and indirectly. Gross domestic product shrank by 1.5% in the third quarter of 2021, and 320,000 jobs were said to have been lost. Many smaller businesses did not survive this impact. Of course, the big effect will be on foreign domestic investment. Foreigners generally looked at the July unrest and said South Africa has a problem. The rule of law here is not properly implemented, and that is a concern if you are an investor. There have also been major problems at South Africa's ports, and that has been a major impediment to economic recovery. It's now taking 210 hours or 9 days to offload or unload a ship in Cape Town Harbour. The situation has been worsened by bad weather. This is impacting on quite a few industries, notably the wine industry, which is a large exporter and also a large employer. Apparently there are long queues of trucks waiting outside the port to offload. Okay, the commodity boom has resulted in tax revenue being about 200 billion more than was budgeted for last year in February. This means that the government's deficit as a percentage of GDP is likely to be below 6% when Godongwana reports in February. Fitch, of course, has shifted their outlook for South Africa from negative to stable. That's positive for us. South Africa was also commended for its handling of the COVID-19 by the World Bank and won a $750 million loan, about 11.4 billion rand, because of its fast reforms, which is quite surprising, really. And there they quoted, of course, the move to the 100 megawatt limitation on distributed generation of power. Predictions of GDP growth in 2021 are all around 4.8%. That's last year. And this year, the Reserve Bank is expecting growth to be about 1.8%. The IMF is talking about 1.9%. We think these figures are conservative. We're expecting somewhere between 2% and 2.3% in 2023, but we could well be wrong. Of course, all of these numbers are still well below the 5% which is needed to absorb school leavers joining the workforce every year. Many structural problems remain in the South African economy. It has been suggested that we use some of the commodity tax bonanza for social spending. The basic income grant idea is suggested to replace the 350 Rand a month grant, which has seen us through the July unrest and so forth. And it's also been suggested that that grant be increased to 595 Rand a month, because that is the food poverty line in this country. The cost of this would be around 56 billion a year. And of course, Godongwana opposes this. And the President's Economic Advisory Panel has suggested that we only extend the grant for the next few months to give some relief. If we look at the Rand now, so the chart on the screen is the S&P 500. I'm now going to go to the Rand. And let me just get the one I want. There it is. I'm going to put a bit more data on the screen here. what you can see is how the rand has performed. I'd just like to quote from our confidential report of the 1st of December 2021, our last confidential report, where we said, "It is important to understand that the dollar strength has impacted negatively on most first world currencies, and the shift to risk on has negatively affected all the emerging currencies as well. In our opinion, the rand has held its ground remarkably well in the face of this sell-off. We do not believe that the current weakening pattern will be sustained. We are expecting the rand to resume its long-term strengthening trend in due course." So we said that on the 1st of December, about nearly 2 months ago. And as you can see from the chart, that confidential report was actually published here, right at the peak of this trend. And since then, the rand has been strengthening, and it's come back to find this lower trend line here. And we fully expect that strengthening trend to continue. Some of this, of course, is due to the weakness of the US dollar. But we did previously identify this 15 Rand 40 support level, and it appears to have been quite important during this during this period. And of course, the rand is now trading around that 15.40 support level. We expect it to strengthen further, though, provided, of course, that there are no more significant economic shocks. Turning our attention to Eskom, of course, they are looking at this just transition from coal-fired power stations to renewables. It's expected that this transition will take about 30 years to complete and will cost somewhere in the region of 300 billion rand. We have already been offered 130 billion rand due to Eskom's CEO, Andries de Ruyter's efforts. And of course, eventually South Africa will have to move to renewables, if only because they are cheaper. The only question that remains is, will this be done slowly and laboriously, or rapidly and with international assistance? We note that Eskom wants to raise the cost of electricity by 20.5% now. Obviously, this would be highly inflationary. Eskom says that it needs the extra money to repay debt. It says the electricity price in South Africa is still reasonable when compared to other countries in the world. Of course, they probably won't get their 20.5%, but I'm sure that they'll get 10% or more. And this means, of course, that individuals and companies will move to renewables. More and more people will move to renewables and away from Eskom. And that, of course, is a vicious cycle, because the less clients that Eskom has, the less profitable it becomes, and the higher it needs to price its electricity. So it's getting fewer and fewer clients, and they're charging them more and more. Of course, Godongwana in the February budget will have to tell us how Eskom's debt is going to be dealt with. De Ruyter has managed to reduce it to 392 billion from about 460 billion, which is an enormous achievement. The splitting of Eskom into 3 parts is a bit of a concern for the creditors, however, and they have appointed Rothschild to evaluate the situation. What they really want to know is how much debt will each of these 3 divisions carry, and where will their debt be placed. Let's turn our attention now to the commodities market. I'd like to start by looking at the oil price, because that has been quite significant. Right, so on your screen now, you should see the oil price. You can see the impact of COVID-19 going down to April 2020, when the oil price dropped below $25 a barrel briefly. Since then, the trend has been upwards, and what we have here is a clear upward channel defined by an upper and lower channel line. And you can see that we've bounced off the lower channel line, and we're moving strongly upwards now, with the oil price sitting at around $90 a barrel. Obviously, this is one of the factors that's causing inflation throughout the world to rise, and that in turn is causing central banks to look at rising interest rates. We expect this increase in the oil price to continue, mainly because we expect the boom in the world economy to continue, and that means more people will want motor cars. And at this stage, electric vehicles have not really had a significant impact on the motor vehicle industry, but we expect they will in due course. Another commodity that we want to look at is gold. Just briefly, from January 2016, Sorry, I just want to put more data on the screen here. From January 2016 over here on your chart on your screen, you can see that is when commodity prices began to rise in earnest, and you can see the gold price has been tracking up very strongly, and it continued to track up when going slightly over $2,000 an ounce in August 2020, and then since then, of course, it has come off with most commodity prices as a result of COVID-19, but it is now apparently tracking up again. So it reached a low over here of $1,750, but it looks like it's on an upward trend. We expect gold to continue rising. The thing that you have to understand about gold is that it is the ultimate store of value. It is a hedge against the weakness of paper currencies, and it is regarded as a safe haven by investors all over the world. The only problem with gold, of course, is that it doesn't pay a return. It doesn't pay any interest or dividends or rent, and it doesn't add 10% to its weight every year. So it's simply a store of value against mainly the weakness of paper currencies. It benefits from high inflation, and it benefits from political instability. Inflation in the US and the UK is rising now, and of course we have the political instability in the Ukraine, where America and Britain and other countries are opposing Russia's expansionist ideas, and that could lead to something we don't know, but obviously that will be good for gold, because when there's political instability, people put their money into gold. We have always advised South Africans to have about and to keep about 10% of their wealth in gold. The main reason for that is that this country is relatively politically unstable. And so, having your money in Krugerrands is not a bad idea. Some of your money, not a lot of it, only 10%, because, of course, it doesn't pay a return, so there are no dividends there. Krugerrands are easily transportable. They retain their value all over the world. You can sell your Krugerrands in Hong Kong or London or New York for the same price that you pay for them here in South Africa. And, of course, they don't have your name on them. That's another key advantage. They are the ultimate store of value. The only problem is their lack of a return. Right, let's look at some companies now. I'd like to start with looking at Auxilia Metal. Of course, this is South Africa's premier steel supplier. And it's an interesting share because if you look at it, here in July of 2020, it reached a low of 25 cents. And today it is trading for just over 1,000 cents. So it's gone up 4,000% in about, 22 months or something like that. That's an incredible return, and you don't often see that on the JSE. Because after all, this is a company that came within a whisker of going under in 2020. And it's made headline losses in every year for the last 10 years except for 2018. And so you can say the decline in the share price to 25 cents was certainly justified. In December 2021, the company has published a trading statement in which it projects that its headline earnings per share will be between 600 cents and 630 cents. So when you look at that, the price of 10 Rand actually looks cheap. Suddenly the forward price earnings ratio is about 1.8 or 1.6. In other words, the 10 Rand divided by the 6 Rand headline earnings per share. That looks cheap. But of course, this is a commodity share, and so you should expect it to be volatile. But that's why the share's gone up. All right, now I'd just like to look at ShopRite. This is a great company. They produced an operational update on Thursday last week for the 6 months to the 2nd of January 2022. Merchandise sales were up strongly. Just want to put now a longer chart on the screen here. Merchandise sales rose by 10%, and the company opened a net 57 new stores. Clearly, the company is growing, despite all the problems of doing business in South Africa, and it is a solid blue chip share. You can see the peak price that it made here on the 7th of March 2018 at 275. Since then, it entered a downward trend. Obviously, its charismatic CEO, Whitey Basson, resigned earlier and sold his shares actually in Checkers for about ShopRite Checkers for about 200 Rand a share. The share subsequently went up to 275 and then started a downward trend. At the time that it started this downward trend, we recommended that you apply a 200-day moving average and wait for a significant upside breakout. That upside breakout eventually came. It eventually came here on the 8th of September, where you see this arrow. And on that day, the price was 129 Rand a share. Since then, it's moved up quite sharply and is now trading for 208 Rand a share. So that's a gain of about 61% in 15 months, which shows how important it is to make use of technical indicators like moving averages from time to time. Another share which is a favorite of ours is of course Lewis, and they produced a trading update for the 9 months to the 31st of December. We like this share very much, and you can see here, there's on your chart, you can see there's the downtrend caused by COVID-19, which impacted on almost all retail companies. We published an article and recommended that you purchase this share here on the 2nd of September 2020 at 1668. Since then, it has been in a strong upward trend, and it's now trading for 5,100, okay, up here. And it's at a new all-time record high. That's where it closed last night. It's on a PE of 7.18. Can you believe that? 7.18, which is remarkable for a really high-quality share like this. And on a dividend yield of 6.12. So, I mean, this share, from a fundamental perspective, is really cheap. And it's still in a strong upward trend. Okay, then I've got two more shares that I want to talk about. Another one of our favorites is Avenge. Excuse me, we've been punting this share for a long time. And they produced a trading update. Just going to expand this a little bit here. Okay, so what you see here is the effect of the 500 for 1 consolidation, which took place on the 8th of December, and that consolidation was done in order to get the speculators out of the share. You know, when you have a share which is trading between 5 and 6 cents all the time, you get a lot of speculators, and there's a huge amount of volume traded, which obscures the true situation actually in the end. So by doing the 500 for 1 consolidation and taking the share from 6 cents to 27 Rand, the company has basically returned it to the institutional share group. So big institutions, fund managers will now look at it again. It's trading more reasonably. But of course, over this period of time, the last few months since it did the consolidation, the speculators have been selling out and going elsewhere. The share price is normalizing. But in their trading update on the 20th of January 2022, they disclosed that their Australian subsidiary, McConnell Douglas, had won orders for a further $1.1 billion worth of business in Australia and New Zealand. Moolmans, of course, which is their other subsidiary here in South Africa, is benefiting from the ongoing commodity boom. And the third company which they own is Trident Steel, which is held for sale. In other words, they intend to sell it. And that performed in line with budget. The current PE ratio, and this is the important thing about Avenge, is sitting here at 2.66. That is very, very low. When you consider that the JSE overall index's PE is around 12.47, and the construction industry specifically is sitting on a PE of 20.28, this PE looks really, really low to me. It's very cheap. And you must also remember that 2/3 of its business is in Australia and New Zealand, so it's actually a Rand hedge share as well. So we think that this share represents value at these levels. The final share that I want to talk about today is Mr. Price. Everybody knows what Mr. Price does, a leading retailer of clothing. Just want to put a bit more data on the screen here. You can see here again the impact of COVID-19, which impacted on all retailers. They also had some stores damaged and destroyed. But they did a trading update for the 13 weeks to the 1st of January 2022. And in that trading update, they said that retail sales were up an amazing 19.2%, which, given the circumstances, was an incredible performance, especially when you consider that they had 41 stores closed at the beginning of that period due to the civil unrest. So here you can see the upward trend that we now can see. The share is trading relatively cheaply at this level now, in our view, and it's on a price earnings ratio of 16.78, which looks cheap to us. We don't think it'll take long before the fund managers spot this and start buying up Mr. Price shares again. Okay, folks, that's what I have for you today. I hope that you have found something there of interest. And remember that I will be doing another confidential report on the first Wednesday of March. And watch out for my articles, which will come out every week until then. Thank you for listening to me.